First of all, thank you all so much for making the time on a Sunday evening. Uh, Personal finance used to be a really boring topic to me a few years ago, mainly because I didn't have money. Not that I have much now, but it used to be super boring. But thanks to people like Aggie and Neeraj, who going to be running the rest of the show here, it's become a lot more interesting, and it's something that I've developed a lot of interest in, both via my consumption habits on Twitter, books, and sort of beyond as well. It's one of those things I bond with a lot of my friends over. Um, Obviously, the trigger for all of this was like this uh, very off the cuff sort of a tweet that I put out about opportunity funds and emergency funds, and it seemed to resonate with a lot of people. And of course, clear disclaimer that none of us are financial advisors. None of what you hear on this discussion, webinar, whatever you want to call it, can be construed as sort of financial advice. Please do your own homework, do your own research. This is just meant to be informational at best. Uh, but having said that, Neeraj and Aggie do know a little more than I do. Um, Aggie sort of was in the same boat as me until recently. He's been sort of an entrepreneur almost all his adult life. Uh, and later on, more recently, he got serious about life, and that's when he started doing his homework about personal finance. And in true Aggie style, sort of he jumped in the deep end of the pool, and he's been sort of instrumental in making an entire generation of folks. Among my Twitter circles, at least, more sort of financially literate. Via he has a small ebook sort of a course as well, and he does these sessions with a few early stage companies where he goes and speaks to 20-year-olds and teaches them about financial literacy. Uh, so it's been awesome sort of learning from Aggie and learning with him as well. Um, Neeraj, and I'm sorry to dox you here, Neeraj, but Neeraj runs this pretty awesome uh, blog and so far anonymous handle on Twitter called Quant Living, Contrarian Living. Neeraj's an inspiration to me just because he's barely, I think, a few months older than I am, and I hope he won't mind me saying this, but he's pretty much either on the path to or has achieved financial independence. He's he's sort of a big proponent of the FIRE movement, and he's hoping to spend the rest of his years sort of propagating that and helping other people achieve financial independence. Uh, Him and his wife have an amazing sort of lifestyle. And their journey has been very inspirational to me, and I've learned a lot from a lot of his newsletters and blog posts as well. So I just thought I could sort of represent the average desi startup person, which I think most of the crowd is. But if we do have diversity, please feel free to call that out and let me know if I don't ask questions on your behalf. But I just have like a bunch of questions just to ask these guys, and I want to keep it very, very conversational. Feel free to sort of post your questions in chat in case I miss out on anything. In case you feel very strongly about any topic, also feel free to put that on chat, and I'm sure Aggie and Neeraj will get to it. I feel like I've been on a monologue, so I'll pause here. Aggie, Neeraj, over to you guys for a quick intro.
Sure,
All
I
right,
can start.
Go for it, Neeraj.
Yeah. So Nikhil has given a good introduction, but I am a proponent of financial freedom, not a big proponent of retiring early. Though I quit my job recently, me and my wife, both of us have quit our jobs. She's started a full-time yoga practice. I'm starting a full-time advisory and doing a lot of other things on the side. So being an early learner, I started this journey at the age of 22, even though I was working from the age of 18 as an intern at because I am a chartered accountant, so I have to start working at 18. So yeah, so I got into this early, and thankfully I've been able to build up that corpus to support me, do things which I like to do and not work for someone else. So that's my introduction.
Abhishek, over to you. Hey everyone, Abhishek, Aggie, otherwise known as pretty much by most circles, startup and otherwise. I am one of those cliched engineer MBA folks, graduated 2010 out of B school, spent 5 years with strategy consulting, all through which the only kind of investments I did was either buy a piece of land or fixed deposits, and that's it. We did not really understand that, managing money should be as important as making money. I think then I sort of deep dive, started with my own entrepreneurial journey, had a startup called Boldkin, set up also an early stage fund investing in startups called Operator VC. Ran all of that in 2018 for about 4 or 5 years. 2018, I shut it down. The fund continues, but I shut down my company. And, post that, I've been heading strategy at a company called NinjaCart till earlier this year. And May is when I moved on from that. And, post May is actually from the initial of the year. And after May, I had a lot of free time on my hands, which is when I went really deep into everything personal finance. And I'm also getting married in January. So that was one of the triggers to, figure this whole thing out for both me and my wife my to-be wife as a unit. So went really deep, spent a lot of time speaking to people, understanding, reading, blah, 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 all of it. And I think I've come out at the other end with a semblance of a plan. And also being able to create that plan is actually what helped me create a structured approach for people who want to create a plan for themselves, and or more an approach as to how to think about financial planning. So yeah, that's been sort of the context. I've moved from somebody who had two extremes of investments, either FDs or startups, to now having a much more intelligent and an intentional, deliberate approach. Yeah, I think without further ado, let's sort of get into emergency funds and opportunity funds, which is what we're going to be talking about today.
Yeah. So, Aggie, why don't you sort of kick us off with sort of just setting the context on why does one actually need an emergency fund? Like, who needs an emergency fund, and why do we actually need one? Like, just a macro level.
Sure. I think an emergency fund is something nearly universally everyone requires. I'll qualify that by saying that, if you kind of have your own income and your own set of expenses, then you need an emergency fund. It's as simple as that, right? If you're a kid in school whose parents are sort of covering for everything, then that's not something for you to think about. That's something for your parents to think about, possibly. But the moment you have your own income and your own set of expenses, it's definitely something you need. And I think this year itself, it very much has been for me. I think it has for nearly everybody else, either through personal experience or through, seeing very, very close shared experience of people either suddenly getting out of jobs or leaving jobs or being in phases of transition where you're suddenly cut off from what you thought was a constant source of income. And then you're like wondering, what the hell do I do now, right? So an emergency fund, from at least say a COVID lens in this last year, has looked like employment risk. But this could become anything and everything, right? For a smaller set of people, it's been somebody in the family getting COVID extremely seriously and a hospital bill running up to 20, 30, 50 lakhs, pretty much anything, right? An emergency fund you definitely do need. The reason you need it is, well, Murphy's Law. Anything can go wrong. And the point is, at some point in life, something will go wrong, right? That's a given. I think, touch wood, nothing does for any of us, but let's assume that it will at some point.
Yeah, we have had 2020 has been a great example for all of us to realize
Absolutely.
the importance of emergency funds. It could be even though you have insurance to fall back to, but there may be certain things which are not covered by insurance. So in that cases also you may need an emergency fund. So never believe that you're always covered.
Got it. So Neeraj, let's sort of get into details, right? Like, and I'm sure like everyone on this call has heard different versions of the formula, right? Like, I've heard stuff ranging from 6 months of expenses to 12 months of expenses to 6 months of income to 3 months of income to 12 months of income. Like what's that sweet spot? And I'm not asking for a magic formula, but like, how do I figure out what my emergency fund size ought to be, depending upon my stage, my earning capacity, all of that sort of stuff?
Yeah, so there is no one formula, to arrive at a figure of the emergency fund which one needs. It depends on a multiple factors, like what is the level of net worth you are at now, what is the level of debt you have, what is the how many sources of income do you have. So if you have only one source of income, then you really need an emergency fund. But you have 5 or 6 sources of income, then do you really need it or not? And then if you're a multimillionaire, do you need an emergency fund? I don't think you need one. But you've just started, and you have a lot of dependence on you, then you definitely need. So what the industry recommends, 6 months of emergency fund, like 6 months of expenses, all the bare minimum expenses plus your school fees and your insurance costs and all those things should be covered in emergency funds. But it is up to you to decide how much you want. For me, like if I am advising someone, it could be between 18 months to 36 months of emergency funds, so at least 2 to 3 years of expenses in as an emergency fund separately put aside. Don't have to do anything with that. Just let it be and evaluate after every 3 or 5 years. If your expenses have increased and do you want to put in more money towards your emergency fund.
Carl, but like, where does one keep this emergency fund, right? Like, is this sitting in an FD? Is this in my savings bank account? Is it like an overnight fund, liquid fund, gilt fund? Like there seem to be so many options. Like, how do I sort of figure out?
Yeah. So two things I think people need to keep in mind when investing their emergency fund. It has to be safe and it has to be liquid. So what I believe is you can distribute it over 3-4 places. Keep some cash at home. At least 1 to 3 months of cash should be at home. Why? You've seen lockdowns, you've seen demonetization, you've seen ATMs will run dry. People may not accept Paytm or credit cards or whatever may happen. So always keep some cash at home. I'm also a big proponent of Morgan Housel. So some money at home always allows me to sleep peacefully at home. So I do that. And then you could put some money in a savings bank account. Few months of expenses in a savings bank account. Easily, it's liquid, it's safe. You can withdraw it immediately. Then some could go in a fixed deposit, some could go in a liquid fund. I would say don't seek returns from your emergency funds. Returns can come from your equity investments, from your startup investments, and other places. Let this be for your expenses, to take care of your emergencies.
I think just to add to that, the emergency fund is fundamentally solving for a peace of mind and a really messed up situation. And you don't want to have any headache of any form to be able to access that capital, that money at a moment's notice when you need it. Because, a parent has COVID, somebody has COVID, you don't really have the mental bandwidth to deal with anything else at that point, right? So you need this to be extremely seamless, extremely simple. This has to be in something that's absolutely zero risk, right? So nothing that's corporate bonds or anything of the form.
Because, when an emergency comes, what do people do? They either resort to a personal loan, which costs around 15%, or a credit card loan, which costs 42%. So, or they dip into their long-term investments. They break their, equity investments and take out money from those things. So that should not happen. So that is why, this fund is very important and everyone should have it. Again, it also depends from people to people, circumstance to circumstance, if one needs it or not. But again, as a general rule, everyone should have it.
Look, so here's sort of the next step, right? Like, how do I go about either accruing this or putting it aside? And I think I speak for most of the people in this room. I don't think most of us have enough liquid cash for 36 months of expenses, right? I'm sure a lot of us here have either SIPs and mutual funds, or we're just dipping our toes in the stock market, or we bought some Bitcoin, or we invest in startups or something of the sort. But essentially, I don't think most people, the average person, does not have 36 months or 18 months, or I would go to the extent of saying even 1 year's worth of expenses in a liquid place. If we don't have, do you recommend that my next 2-3 salaries, I just put that into this, or do I continue making my investments and set aside like a small percentage and keep putting that into my emergency fund? How do I sort of go about, what's a good framework?
So see, the likelihood of anyone having an emergency tomorrow is very low, but having an emergency over the longer term is high. So, if you take that case, it's totally up to you. How do you want to do it? You want to put in your next 6 months of salary as an emergency fund, do that. If you want to put aside 5 or 10% every month for next 2 years or 3 years, you can do that. As long as you're putting in some money aside for emergency fund and, you have a goal in mind, you can do anything. You can also, reduce your expenses and use that money to, put aside as an emergency fund, or you could take up a second job, maybe. So there are multiple options, but it is up to one to decide what they want to do. But someone
different. Yeah, sorry, go on here.
One last thing. Yeah, someone who is deep into debt right now, and is paying a lot of EMIs, for those I would say stop, putting money in equity or Bitcoin or any other instrument and just start saving for an emergency fund immediately.
But like if somebody is in debt, like do they get rid of the debt first and then start doing the emergency fund? Like
again, it's it's something that needs to be decided by a financial advisor, because one debt may be costing 7%, but another debt may be costing 15%. So which one to get rid first? You have to decide that. And does the lender allow me to pay it immediately? So there are a lot of things which need to be discussed and thought about. So it's again, it's a very long discussion. So I don't think now is the right time to do that.
No, it makes sense. And
just to chip in for a second on that, Joyce, I think especially for one is slightly earlier on in stage of life perspective, I think a pretty solid sort of benchmark to have is about a 6 month of expenses, as an emergency fund. And at least the way I think about it is that to me, probability wise, while it's nearly a given at some point in life you need it, you really don't know when that could be. And it could be as soon as next week. So the way I at least think, or if sort of two friends, I would suggest that get hold of the emergency fund first, because from an investing standpoint, that capital building can continue to happen eventually as well. But it makes sense to sort of take out at least, maybe say not 6 months, right? But at least take out 4 months and put it away immediately, right? And if that means that for maybe 2 months you're not investing anywhere else, that's fine, right? But just take out this money and have it ready, God forbid, something happens. And from a debt perspective, again, I think as Neeraj rightly said, certain debt will make sense to cater to before your emergency fund if you can and if you're allowed to, and certain debt will not. But at least that's I would err towards the side of getting the emergency fund in place as soon as you can, and then sort of proceeding with life.
But like, so Aggie, aren't there like other things that we can do that could be alternatives to emergency funds just to safeguard assets, right? Like, I don't know, like, does a credit card sort of count? Does insurance count? Like term insurance, health insurance, all of that, like, does that count as sort of part of the emergency fund?
Fair. So credit cards, not really. It can be a source of capital for sure when you certainly need it, but it's an insanely expensive source of capital, as Neeraj said, right? It's effectively usually between a 33% to a 42% annual interest rate. And you can't count on that to cater to your emergency, right? When suddenly an emergency happens, well, maybe you need it, right? Maybe you have 10 lakhs saved up and you need another 1 lakh, so you use your credit card for that. But that's not what you should rely on as a source of your emergency capital for sure, right? So credit card, definitely not. In terms of other investments, again, it goes back to the question of are they liquid, which basically means can I extract them, can I get hold of them within a day, like within hours? Actually, a day is also too long, like almost immediately. And are they safe in the sense that, let's say I put in 10 lakhs now, will the value be at least a 10 lakhs, or can it like fluctuate a whole lot? So if you're looking at anything in the stock market, that 10 lakhs could be worth 8 tomorrow, right? You don't know. And again, with stocks, it will take you at least a day or 24 hours to be able to get the capital back into your account to be able to use it anywhere. And you may not have that kind of time. So that's where, it's a little tricky in terms of where you want to keep it. You ideally, again, right, it's cash in hand. So whether you're keeping it in your home or in your bank locker, cash in the bank, which is in your savings account, or cash in a FD, and a FD, which is, sort of you can break, or is like linked. There's something called linked FDs. So you can directly even swipe your card. The bank will just break the FD on its own so that you can get the money. I think those would be where you should think about the money being.
Yeah. No, you make a good point about the sort of the investment bit, right? Like, and sort of this ties into the tweet that started it all. But like, so question to Neeraj, right? Like, Neeraj, what are some instances of things that I can dip into my emergency fund for, and what shouldn't I? Like let's say tomorrow there's like a market crash like that of March 22nd. Do I have to be stoic and say, you know what, this is an emergency fund, this is for emergencies, and not dip into it? Or can I sort of be finicky about it and like take like 10-20% from there? Or is there like, what counts as a good use of an emergency fund and what doesn't?
Yeah, so deciding when to use your emergency fund, I use this approach where the event which is called an emergency is an unplanned event. It's an unexpected, unplanned event, and it has worse consequences. And you never expected that event to happen. So a 20% or 40% market crash, everyone expects to happen once in a decade, right? But someone ending up in a hospital, because of COVID and getting a bill of 50 lakhs, unplanned, unexpected, worse consequences. So you need to dip into your emergency fund, but not in the case of a stock market crash. So I would say that never use this money to invest or to generate any kind of return. This is only for emergencies which are unplanned and unexpected, and will have worse consequences if you don't spend that money. So that's
Yeah,
my rule.
got
Yeah.
it. And how does sort of the emergency fund mindset change when you're no longer single or when you're in a familial unit, right? Let's say like Aggie's getting married in January, right? Like now, does Aggie have a separate emergency fund and Forum have an emergency fund that's separate, or do they have a combined fund? Like how would that sort of work? And Aggie, how are you thinking about it? Because I took your example, and also Neeraj,
Sure.
if you have any tips on that, yeah.
So I think for us, the way we've defined it as, I think, today couples very transparently discuss finances. And I think it's usually one of two ways that a couple kind of ends up managing their finances, right? Either completely independently, where each person is sort of managing their own money and they're kind of splitting the cost of life or whatever, or they kind of combine capital and they're just, they're managing it as a single unit. So we chose the latter. And given we chose the latter, what we kind of did is we defined that, okay, here's the amount of an emergency fund we're comfortable with. And then we just kind of split it in two so that she has access to half and I have access to half. Basically also because, what shouldn't happen is I'm in the hospital and I can't really tell my card pin or my internet banking. I can't access all that, but we need the money and it's not there, right? So that's why you sort of, we need to ensure both of us have the capital. And what's also happened as a result is if ordinarily, let's say one would have said that, 10 lakhs is enough. Now, because we're splitting it 5 and 5, we've actually just made it say 7.5 and 7.5. So that both of us have a little higher if the other person can't actually get access to the capital immediately for whatever reason. So, that's how we've at least, I think, figured it out as a couple. To the question, generically, I think from a life stage perspective, you need to be very laser clear to understand what are the must-have expenses for you basis your life stage, because that will materially change, right? The moment you have a spouse, there are n things that quote unquote could go wrong, or n expenses you absolutely need to account for. The moment you have kids, that equation again changes, right? You really want to make sure school fees is a part of emergency fund. You don't want to have to put them out of school, for example, right? So stuff like that, I think, is the other thing. Neeraj,
Yeah, you need to reevaluate this at every significant event in your life. Getting married, having kids, having parents dependent on you, you falling sick, or you getting disabled, whatever, anything could happen. So you keep reevaluating at every significant events the need for an emergency fund. And also, again, these things are personal decisions. If you want to manage your money as a single unit or differently, then once you do that, your number changes. So it all depends on how you want to approach this.
Got it. So I want to sort of move to the opportunity fund bit, right? And we haven't spoken about that so far. And while you guys were talking through this, I realized it's a very sort of for lack of a better term, it's a very first world problem to be able to even afford or have an opportunity fund. So, I mean, who should have an opportunity fund? Like, is it only after you're done with your emergency fund? Matlab, do I still set aside 5% or 10%, or like Aggie was saying the other day on Twitter, do I set aside like 10 lakhs just to keep it ready in case there are a couple of like startup deals coming, or if there's a market crash or something? Like, how can you give us some frameworks to think about this?
Sure. So from the way I think about it is that definitely the emergency fund first. That's the way I think is, optimizing for upside comes after you've taken care of your downside, right? because otherwise you're literally going to be in a place where you hate yourself as to why the hell did I put the money there? I should have just, like, you don't want to be telling yourself I told you so in some form. So I think the emergency fund first, without a doubt. The moment you've been able to put together your emergency fund, I think an opportunity fund makes a lot of sense for pretty much everybody. It would not make sense for people who are either, if you're not actively investing into the equity market yourself, and you don't want to, even if like pretty much everybody's saying ki market ekdam gir gaya hai and it's really low right now, it might be a good time to invest. If you know that even then you wouldn't want to do an investment yourself, you probably don't need a fund. If you're not somebody who will put money into, say, an early stage startup as an angel investor, if it's a really good deal that you happen to come across, or let's say like Nikhil Joyce is starting another company and he allows you to invest and, you don't, that sort of a thing. So, but I think for most of the people here and whatever I understand of, most of us who we have gathered here today, it would make sense to have an opportunity fund. And you can start to sort of put this together after you've got your basics taken care of in terms of your emergency fund and your, servicing debt, etc. And I think this is where I would say that keep adding to your opportunity fund a little bit, and whenever and as and when you can, keep taking out money from the opportunity fund and sort of throwing it into certain opportunities here and there as well.
I have a little different approach, to opportunity fund.
I thought so.
Yeah. So one thing is like a lot of us on the call don't have access to startup investing, right? And also the access to startup investing is possible only after you achieve a certain level of net worth. Someone with 50 lakhs, does it make sense for him to invest in startups? I would say no, because the risk of losing money is pretty high. So once you've achieved a certain level of net worth, start following the barbell strategy, coined by Taleb. 80 or 90 rupees out of 100 stays in, in equities and fixed income and bonds and all those instruments, and play with 10 or 15 rupees. You can invest that money in startups or Bitcoin and, such risky instruments where the probability of losing money is quite high. And even that 10 rupees should be spread between 10 to 15 or 20 investments probably, so that the probability of making money out of 20 investment rises, right? And secondly, so think about at what level of net worth do you want to do that, right? Everyone may not have access, and also think about, I've written about the Taleb strategy also, the barbell approach. So because honestly, I don't have access to startup investing. Maybe now I may have access since I have access to both of you, but but before meeting you guys, I never had any access. Maybe say for example, Naval Ravikant runs this angel list. So he has this index fund for startup investing, but even there you need a minimum amount of net worth to invest your money. So this may not be applicable to all, and I would say it's not even really needed for everyone. You don't have to invest in startup. Just follow this barbell strategy. Use your or follow the asset allocation approach. That is much better. 50 rupees goes in equity, 50 stays in cash. Whenever equity goes up to 70, I will stop investing in equity and I will put more money in cash, and the vice versa. That is the best approach for the larger crowd.
So just to sort of double click on that, Neeraj. So do you mean to say that in case my net worth is not at least, a little over like maybe a crore or a couple of crores, and I'm still in that sort of wealth creation phase, not yet on my way to financial independence, do you then, how do you recommend like target, like, and the March 20s of the world, right? Like March 22nd of the world do happen once in like maybe a decade, once in 6 years, whatever. Are you then recommending that that's when one looks at their investments and just like says, maybe this is when I get out of bonds and get into, and even if I'm not an active investor, right? Like this is when I go into like an index fund or something of the sort, rather than setting aside actual money for, investing itself, if I don't have startup investing.
So two things. One is like for a 22-year-old who is just starting, for him, achieving first $100,000 or first crore is more important than, where he puts his money. So he should focus, on that. And after you have achieved 1 or 2 crores, after that, start following the asset allocation strategy, maybe where you put in 60 to 80% in equity or similar instruments, and the rest stays in cash. And as and when 60 goes to 80 or 60 falls to 40, you rebalance, or follow a approach where you rebalance on a particular date every year. That is also a good approach to follow. So there are multiple rules for asset allocation. You could put in some money in equity, put in some money in gold, maybe put in some money in fixed deposits, fixed income, and some can go to Bitcoin, because Bitcoin is accessible to everyone, but startup is not accessible to everyone. So maybe 2 or 3 rupees out of 100 can go to Bitcoin. So something of that sort could be done.
Got it. We have a few questions that we can sort of. Sorry, Agi, go ahead.
Yeah. I was just saying that, from a steady state perspective of how you think about investment, I think the challenge I've seen with both myself and, let's say, a lot of folks I've spoken to in the last year is that it's often not deliberate and is without intent, right? So one is doing something without knowing why you're doing it and what you're really trying to do. And that's often where a lot of people also kind of get screwed up. So it's really critical to take a step back. And as Neeraj outlined, there's a bunch of different thought processes you can follow. And it's up to you to figure out, okay, this thought process makes sense to me, because for every thought process, there are people who love it and have made millions off of it. And there are also people who hate it and have lost a lot of money off of it, right? You have to figure out what is it that makes sense to you fundamentally, and what is it that you will be able to stick to even in the worst of times when it's performing at its worst. And that's from a very macro perspective. And I think within an opportunity fund context, if you think you have had access to opportunities, and not in hindsight, right? You have to sort of, in hindsight, all of us know that we would have taken money and put it into the stock market on March 22nd. But did you, and you have to be true to yourself, did you on March 22nd know that if I had money, I would have put it or not, right? Because a lot of people will think they would, but you actually wouldn't. I myself might be one, for example. So if you have come across opportunities where capital was what was holding you back, right? You wanted to put money, you just didn't have money. Then it makes sense to slowly and steadily keep building a little bit and use it as and when you can. I think you'll, in a bunch of ways, you'll burn your hands. Make sure anything in the opportunity fund is, you're not relying on it to make you money, because it can go sideways, right? Something in the stock market, when the stock market is low, will possibly, hopefully still work out in the longer term. But a Bitcoin or a crypto investment might also equally go to completely nothing.
Yep.
Right. It's as might a startup investment. So it should be capital you're possibly not overtly dependent on in any form, for sure. Yeah.
It could be it could be considered another form of emergency fund, emergency to invest.
Upside emergency, basically, right?
Yeah, absolutely.
Yeah. Got it. So we have a few questions. The first one's actually easy enough for me to take, and then I'll get the rest onto you guys. Abhishek asks, should I pay my credit card undue bill first, or put that money in stock market, or do some short trading? Please pay your credit card bills. It does not make sense to go into credit card debt whatsoever. They have insane sort of rates, and it really affects your credit score. And that can have like sort of a snowball effect on your life later on. Let's say tomorrow you want to buy a house, you want to get a personal loan, you want to do something else, you want to start a business and you want to get a loan for that. It's going to affect all of that. So get rid of the small portions of debt, especially if it's credit card debt. Do that. The equity markets aren't going anywhere. Short trading in general is not going to make you very rich unless you're a professional and do that. So please do that first.
I would say do it immediately. Borrow, if you have to borrow from your parents, do that and pay it off.
Yep. That's how urgent that is.
Yeah.
Absolutely.
Second question from Gauransh. Gauransh, no questions, noob, so don't worry about that. But he asks, if somebody's just sort of passed out of a college and they're just starting to save, how should they sort of go about it? What's a good place to start? Is it sort of a separate account? Is it mutual funds? Is it gold? Is there any framework you guys can give on that?
So Gauransh, I think to think about it in two forms, right? One is you're saving money, right? Which is you just sort of graduated from college, and whether it's pocket money or your income, etc., you're taking as much of it as you can and saving it and not spending it, which is great, right? And then there is, okay, once you've saved it, where are you starting to invest it, right? Or where are you putting it? And this is where I would say that, hey, if you've figured out the saving part, then here is where you think about maybe the emergency fund first. Then you think about what's the insurance you need to get for yourself and let's say parents or any other siblings if they're kind of dependent on you in any capacity, right? So term insurance from a life and death perspective, health insurance from overall health and any other things. If you drive a vehicle or you have a car or a bike, then you want to get any form of motor insurance and stuff like that. So the point I'm making again is when you're thinking about where to put the money, that has to be very deliberate and intentional, and it will be a mixture of everything, right? You have to get an emergency fund in place, then an insurance, and then whatever's left over, you'll put some of it into a mutual fund, some into gold, some into stocks, X, Y, Z, and then it becomes a portfolio asset allocation approach, which is what Neeraj was also talking about. The important thing there is to make it deliberate and not random key. Somebody told you to put some money there, so you went and put it. No, take a step back, think about where and why you're putting it, and then kind of deploy it.
Yeah, there is no straight answer to the asset allocation approach also. How suppose you're putting in 90% of your money every month in equity and market crashes by 50%, would you be okay with that or not? You have to decide that first. If you're not okay with a 50% crash and seeing your money go down by 50%, then don't put 80 or 90% in equity, put 40 or 50% only and see how you react to market crashes. Learn from that and then eventually increase your allocation. But first take care of all your insurances and emergency funds for sure.
Yep. Gauransh, I would just add to what Neeraj and Aggie said and say, play small experiments with your money, very small experiments, just to understand how risk averse you are. And most of us, if I ask you that question in a multiple choice format, all of us think we are aggressive investors. Most of us are not, and it's completely okay to be conservative or moderate in your approach. Having the stomach for losses and dips is something that you will only learn with experience and getting those battle scars. And it's better you have those the younger you are and with smaller amounts of money rather than when you're older and you're playing with larger amounts of money.
So yeah, you can try multiple approaches: index investing, direct stock investing, or trading. You are young to do that. Just do that. Burn your hands now rather than burning later. Even try, I would say, dip your hands in F&O trading as well and lose some money now, so that you don't do it after you're 25 and start earning more.
Yeah. Priyanka has an interesting question, and I think this is, I think Neeraj is among the three of us, I think a little more qualified to talk about this. But Priyanka says dips like the one in March are not going to happen often. What sort of a more realistic dip percentage range a retail investor should keep an eye out for?
So Priyanka, the dip in March was around 40%, right? And if you see the past history, every decade there is a similar dip. So in 2008 we had the financial crisis, similar dip. 2001, .com crisis, again similar dip. And again there was one in 80s and 90s as well. 92 Harshad Mehta, similar dip. So Harshad Mehta time it went down by 60 or 70%. So there in every decade you'll have a 40-50% dip, every year 10 or 20% dip, and so these things will keep coming. So always instead of waiting. So it may, and there can be a circumstance where there is no 50% dip over the next 2 decades also. It's very much possible. So instead of waiting for a dip, just follow an approach where your money is invested and remains invested in markets irrespective of dips or not. So follow an asset allocation approach. By that way, you're always covered from all fronts.
I think Neeraj is definitely way more qualified, so I would stick on this. But I think to me, what I've heard from people, again, people like Neeraj and others who are experts in who I listen to in that sense is, as a retail investor, don't try and time the market. Largely, right? It's kind of beyond our capability for most of us to get the timing right. Again, in hindsight, looking on March 22, we're like, how we should have invested. But on March 22nd, a lot of us were like, what if this goes further down, right? So I think just sort of leave timing to the gods of the markets and, just have a deliberate, I think this company makes sense. So every month I'll go put this much money in this company, period. That kind of a thing.
And if you know nothing and you want to be completely hands off, and I see a couple of book recommendations already here, I'll just add one to that. There's a book called The Simple Path to Wealth by J.L. Collins. or you could read his blog. There's a lot of free content on there, jlcollinsnh.com. And he talks about how somebody who's busy and does not really enjoy sort of studying the market, studying companies, all of that is surely fine with like broad-based indexes. In fact, Neeraj was referring to Morgan Housel earlier. Morgan Housel very clearly says that, you know, all of his money is either in cash or
Index funds.
a broad-based index funds, some broad-based gilt funds, and a house that he owns, right? Like and a family home. That's about it. So and this is a person that the world's top hedge fund managers sort of listen to. So you don't have to overcomplicate things unless you get sort of a kick out of it, or you truly enjoy it from sort of an academic or a curious standpoint. Don't worry about it, and certainly none of us can time the market, right? Like most of us can't time the market. So
even if you enjoy doing it, do it with 5% of your money for first 10 years at least, and you know, see if it's working over a longer term, and then play with it. You know, then increase your allocation. Even most experts don't invest in stocks directly. They go the mutual fund or index fund route. So burn your hands only if you want to. Otherwise, stick to index funds.
Yep. So I'm just going to take Shreyas's question because it's sort of relevant to what we're talking about. Shreyas sort of asks, you know, how do you think about diversification between equity, debt, cash, crypto? You know, basically asset allocation, right? Neeraj, is that age-old formula of 100 minus how old I am? And having, like, you know, let's say I'm 30 years old now. So should 70% of my stuff be in equity and 30% in fixed income or debt? Is that a good framework to think of? Are there better ways to sort of think about it?
It's a complicated question. There's no straight answer to this, honestly. Again, like I told you, play with, like, if you want, say, for example, 50%, 80% in equity, play with it. Put 80%. See, wait for a crash and see, how do you react to that situation. Otherwise, it's all event dependent. How you react. Your reaction is more important than my recommendation. So there is no straight formula. Even the guy who coined the portfolio allocation approach, he invented that approach. He himself said that I don't follow this formula. I just put 50-50, put 15 equity and 15 debt. So it's all about how comfortable you are. I can't, no one can recommend you a formula to allocate 80 or 50 or 20 in equity. It's all up to you, how comfortable you are, and also what is your situation right now. Do you have a lot of dependents, or are there no dependents? Would you be okay to live in your parents' house and live at their expenses in case the markets crash by 60%? All these questions need to be answered, and many other questions need to be answered. So it's a personal thing, and it is something you learn over the longer term. There's no straight answer which I can give today.
I think the one other thing I'd add to that is every asset class has inherently a different tenure, as some form of a minimum tenure attached to it, in a certain way. As an example, if you invest into most debt funds, you're ideally putting in money for at least a 3-year horizon there. And the logic for that is basically it's after a 3-year horizon that, if you withdraw it, the returns you made are, you're paying lesser tax on it. So it's just tax efficient, right? So debt funds would have their 3-year tenure, roughly, in terms of what you think about. Equity, you can say confidently that I don't know what the hell will happen in 5 years, but in about a 5 to 7 year timeline, it will go up, right? So then you're kind of investing in equity from a 5 to 7 year timeline. Liquid funds are much shorter, right? Within like maybe 18 months. So what you also need to do is think about where you are in life. What are the planned expenses, potential expenses that are coming? A car, a house, an EMI, a child suddenly going to college, or XY, or a child's marriage and stuff like that. And accordingly also adjust how much of your money is parked, right? So that you know that, okay, if I put this money here, in 3 years, it can be available to me for this expense that I'm thinking I will possibly make.
There is one more approach which you can follow, is the goal-based investing approach. just list down your goals: retirement, getting married, buying a house, buying a car, and start investing accordingly, so that you don't have to worry. For retirement, your money will be fully in equity. Don't worry about any short-term falls or short-term crashes, since retirement will be at least 30 years away for all of us here. So that way, if you work that way also, it's a very good strategy. There is also a book written by PV Subramaniam on goal-based investing. You can just Google it.
Yeah, I think there's one that he co-wrote with Pattu from Free FinCal. I think that's a pretty good book on goal-based investing. I would highly recommend that book. I'm powering through some of the questions that are not super relevant to the topic, but and if you guys have time, feel free to stick around. I have time. Arun has a question on Bitcoin and crypto. I'm not the guy for it. Neeraj certainly isn't the guy for it. If Aggie has any advice, no, this is outside of our wheelhouse. I've seen my brother use Zeppay, but no recommendation, no endorsement. Really, this is not the crowd for it. You're better off like posting on Twitter and sending each of us a DM and asking us to RT. There's like a bunch of people who can answer that question there. Shravan asks, how often do you revisit an opportunity fund? The things I have under opportunity fund have different maturing cycles, and I'm unsure when to recharge the opportunity fund. Neeraj, you want to take that?
So Shravan, would you like to expand on that question? So are you like talking about, you have, say, 3 fixed deposits, one is maturing in 18 months, one in 24 months, and one in 36 months? Is it something like that? Or, you put your money in long-term yield funds?
Hey guys, this is Shravan. So it's a bit, it's not entirely like that, but basically my personal model of personal finance has been very different. Like, I just keep 1 month's salary of a year as for opportunity fund, and that's how I've been thinking about it. So, but now that I have some investments in it, I'm not sure, like, the most of the things that are in opportunity fund, I'm unsure of what returns will come up and how to go about it as well. So I'm not sure if I want to increase, move it up to 2 months a year, 2 months of salary a year, or reduce it. Just that framework is a bit lost when I'm looking at anything on opportunity fund for me.
You could start seeing it from a portfolio approach. Again, the barbell strategy: 10 rupees, not more than 10 out of 100 will stay invested in my opportunity fund and opportunity investments. If it goes to 20 or 25, you start liquidating those, and bring it down to 10. So this is a thumb rule which you could follow probably. Aggie, any thoughts?
Yeah, I think you have to be selective with the opportunity fund, right? That's inherently how you're defining it. So I think you can't be planning to just keep putting in a whole bunch of capital at anything and everything that comes along your way, because if you see yourself doing that, then some of those things should probably become a part of your core investment strategy itself, and how you're thinking about sort of deploying your money over a bunch of stuff. The moment you're calling it an opportunity fund, it also, by the nature of it, it has to be a little less deliberate, a little more random, a little more serendipity. Is how I think about it, where forcing too much structure may not just sort of work for those kind of selective things you're doing, right? And if you see you're doing them too much, you need to then sort of take a step back to say, well, is this just sort of part of my strategy that I'm just calling opportunity, but is basically my strategy?
Got it. There's a question on housing by Rahul. I don't think we have the time to tackle it, and also I feel like the very fact that he asked that question, he deserves a 1-hour call with me to discuss that later on. So we'll get to it if we do get the time. I know what my answer is. I think I know what Neeraj's answer and Aggie's answer is as well. So I'll talk to you later about that, Rahul. JK is asking, how does a low net worth individual get access to startup investment space? Speaking of 2 to 5 lakh investment, I don't know what Neeraj and Aggie think. I think if you consider yourself a low net worth individual, you should not be investing in startups unless you have crazy deal flow, which it does not look like you have, right? Like you're saying, get access. So unless you have a major sort of unfair advantage by getting insane deal flow, or you have money that you absolutely don't mind going to zero, startup investing is not for you. Please do not fall prey to the FOMO just because every second person on Twitter has angel investor in their bio. Very few of us have the stomach to start startups. A smaller subset should have the stomach to invest in startups. It's a very, very risky asset class, and unless you understand it really well, you should not be putting even 2 lakhs or 5 lakhs into it. Aggie, Neeraj, anything you want to add there?
I totally agree with you, Nikhil. Stay away from it for now.
No, I absolutely agree as well. And I mean, I know I say this as somebody who invests in startups, but it's I understand that there is definitely a very strong FOMO, but it's really not worth it, because if you're not seeing the absolute best of companies and a very large number of them, there is absolutely no way that you can for sure invest in, nearly the best of the best. And if you can't do that, there is absolutely no point of doing angel investing. It's also very illiquid. It will take you like at least 5 to 7 years before you can probably see some of that money back if you do. It makes absolutely no sense to think about it unless you, as Nikhil said, have a very deep edge. I'm going to sort of, link into the chat something I wrote a few years back around thinking about angel investing. It might sort of help some of you. But yeah.
There's also a really good Twitter thread by Ritesh Banglani, who's a VC, on this. If you just go on Twitter and search @Banglani Angel Investing, it should show up. It's a pretty good thread that he wrote. But really, JK, unless you're willing to spend all of your weekends listening to startup pitches like Aggie and I do, and you don't mind whatever portion of money you've set aside from a barbell perspective that Neeraj said going to zero, you shouldn't be looking at startups. Shreyas's question, I think, got answered. Rahul's asking about reducing tax exposure. Is there any tip on tax exposure?
I would say get a financial planner to do that.
Rahul, I will talk to you.
Yeah.
I know you well enough that I can do that for you. Yeah. Cool. So
it's a very
let's.
tactical question on where you put money and when and how much, and it's not strategic. It's much more tactical, to be honest. Yeah.
Yep. Lakshmi Tejas is asking, how much should we put into emergency fund monthly when you have an earning of 25K and 20K earning, all 5K into emergency fund?
I think Lakshmi meant 25K earning and a 20K expense.
Got it.
Yeah. So I would, I think again, that's where we've already shared some perspective between Neeraj and I would default to probably putting all 5K towards an emergency fund from sort of day one and building it up to a level where you're comfortable with, and then sort of proceeding with life. And maybe that could just be like 3 months or 6 months of expenses for you, right? That's how I would think about it. Neeraj, I think, would.
Or you could also take another approach. Everyone who is employed here also gets annual bonuses. So use that money and put it in an emergency fund instead of spending on a holiday or a gadget.
Yeah.
Got it. Paul's asking, once the emergency fund, the insurance, the tax exposure, etc. are covered, can we just hire a fund manager to run the rest of the show? Capital growth for a potential 100K to 1 million journey.
I personally don't think so. I don't know if you're talking US or INR, but I think it's relevant.
I think Paul's based out of India, if I remember correctly. He used to work with Sharath at Eder Labs. I think I got that right. Paul, correct me if I'm wrong.
Got it. Yeah, he said yes. So
cool.
I think people, the full fund manager approach where you just give your money to them and say grow this makes sense when you have a sizable corpus significantly beyond like 100K to a million. I think 100K to a million journey is something where you can use advisors, but you're still going to have to sort of think through and hustle through at your end. I don't think at that kind of scale we have access to the kind of financial minds, both in terms of how much they cost or their time or their minimum book size that they will manage for you, where it can make sense. That's my take, and that's what I've chosen to do for myself as well. Literally, right, where I'm trying to say that okay, I want to do the 100K to a million kind of a journey, and I think I'm doing that with a combination of applying myself to it, and for a certain set of things, taking inputs from some advisors. Yeah.
Paul, I think what you should always remember is that risk always lies with you, not with the fund manager. So even if you invest with 1 or 2 fund managers, the risk of losing money or not the money not growing is always with you. So always remember that. And secondly, if you go online and just do a Google search of people from the FIRE crowd, they have achieved $1 million of net worth just by investing in index funds in US. So, that is the simplest approach to achieving $1 million instead of playing around with fund managers.
Yep.
So,
Which brings us to the next question that Rashmi has, right? Like, how does one find or select a financial advisor?
Tricky question.
Really
So
hard.
I have a sort of an answer for that. One of the guys, I think Neeraj alluded to him as well, is this guy called Pattu from FreeFinCal. He's an IIT Madras physics prof who also runs like a YouTube channel and a blog, and he has a list that he updates on fee-only advisors. So if you Google FreeFinCal fee-only advisors, you should get a list, and of course, do your own homework, ask around. It's ideal if you have someone within the family or within your friend circles who's already using an advisor and they trust them, and you get that recommendation via word of mouth. But I'm sure there are enough people in India who are like sort of fee-only advisors, and that's how you would sort of go about it. Just in the interest of time, I'm just powering through the question, guys. Vinam has a really interesting question, which is, what's a realistic figure to consider yourself to be financially independent and retired early? I know answer would be depends, but curious if you guys have a figure calculated for yourself. Generic person, married, living in metros, working with an MNC. Curious to know if you've done a calculation and how you went about it.
I would say a net worth of 30 to 40 times your annual expenses should be good. And then you draw 2 to 3% every year from that.
Yeah. So
thought about it is, can I create passive income, which is about at least a 2x of my expenses, ideally, and passive income coming from sort of basically not having a day job. So either this is stuff I've created which is earning me money while I sleep, or it's my investments through which I am getting a certain rate of return. But basically, can I get to a point where I don't need to work and I earn about 1.5 to 2x of my expenses, then I think I'm kind of sorted.
Yeah, and Vinam, just to make sure you don't leave disappointed, and of course the answer is it depends, and it depends on age and stuff. But like if you're in your sort of 30s and by the time you hit 40, you manage a corpus of, I would say, close to 3.5-4 crores. I think you're pretty sorted as long as your lifestyle isn't too lavish in India. Like I would say around that number is what you ought to sort of aim for. And of course, multiple sort of. Nimalan is asking, share the name of the book. Name of the book, the one I recommended was Simple Path to Wealth. I think Prajwal's already put that. Yeah. Can someone, Saurabh Khante is asking, can someone explain debt funds and why to invest in it? Should we go on, guys? Like, I think we've hit the 8 o'clock mark.
Yeah. And this will take a while to explain.
I've sent you a link, Saurabh. I think you can check that out. I think, Joyce, we can come back to questions that are still core to, I think, emergency and opportunity funds. Otherwise,
yep. No, I think let's like pause here. I think we have enough questions to come over. I think a lot of people, I don't know, show of hands, seem to be interested in the whole asset allocation, getting started with investing. What's the difference between an equity fund, debt fund sort of a thing, sort of a investing 101. I think that's an idea for another session, or maybe you guys can talk about the Slack community you run where people can join and stuff. So and we can call it a close because I think we're past the hour mark.
No, absolutely. Okay, fair. Yeah, so thanks to Nikhil, Neeraj and I have been speaking for a while, and we've had our own journeys with our own personal, I think, financial planning. And Neeraj started much before me. As sort of Nikhil also mentioned, I'm a more recent entrant, so to speak. But I think we've separately had the kind of opportunity to be able to actually work with a lot of people and help them through this, right? Me from my course, Neeraj through a newsletter he runs with thousands of subscribers over the years. And in conversations with a lot of people, we were like, this is still insufficient in some form, and what's the next step? And as the next step, what we think makes a lot of sense is to actually create a community of all of us, literally, right? All people like us who are at different degrees of figuring out their financial planning, right? Somebody who is like coming out of college versus somebody who's thinking about buying some real estate, all of us learning together. And so what we'll do is we will send out an email to all of you at the end of the session. And I do request, please take out the time for it. It's a brief survey. It's going to help us think through some pointed insights on how you think about the community. Does it make sense for you? What do you want, not want, all of it? And once we've got that, we'll fine tune what we've already sort of set in motion at our end, and then send you guys out an offer as early bird offer for all of you to join. The basic idea is not to give financial advice in the sense of go put your money here, go do this, go do that, but really together create and build systems that work for us individually using collective intelligence in some form and a lot of effort from our end to build systems that can apply for you both now and for your whole life, right? I'm a huge believer in sort of systemic behavior, systemic changes in systems as models of change, and that's what we want to try and do, help you create the systems for that. So that's what the survey is about. We'll send it to you sort of later tonight. But
yep, and also, all of us are pretty active on Twitter, so feel free to tweet at us, DM us, any sort of feedback that you have and stuff. And if you want any more sessions like this, and I think we have a few ideas from here, we should sort of make that happen as well. I think it was a fun crowd. A lot of you were interactive. And it really felt like 1 hour was a lot little. I think we could go on for like a couple of hours on this, but thanks so much for coming and spending time with us.
Thank you, everyone.
And
Thank
a
you.
shout out to the product folks. I think thanks guys for the Zoom. And what I'm going to do for all of you who are still here is I'm just quickly going to, ping the link to the form, the Google form here itself, right? So whoever's still around, all of you can just kind of fill it now.
No, and yeah, and plus one
just take,
shout out to Suhas and the team, yeah. Awesome. Folks. Thanks
you
again for making the time and do sort of tweet at us, DM us, fill out the form, email us, all of that sort of stuff. We want this to be as interactive as possible, and it's crazy that one small brain fart of a tweet led to something that was so much fun on a Sunday evening. So that's why I love Twitter. Take care and have fun, folks. Yeah.
Thank
have
you.
A good weekend.
Bye.
Cheers.
Bye.
Thanks, Nikhil. Thanks, you.